Hello, my name is Sean Burke. I am the Vice President. I'm going to talk to you a little bit today about how we approach our investment strategy and some things to think about as we go through the different stages of the economy. So, in the economy, we have generally four different stages. We have a period of recovery, a period of growth, sustained growth. We have a period where we slow down, and we have recession. And within those different stages, you have different types of investments that will do better or worse. So we're going to go through that from a high level and then do a deeper dive into the individual type of investments that typically do well in the different parts of the economy. So on a high level, we have our stocks and our bonds. And whatever that mix is for you, that can be determined based on the amount of risk that you're comfortable with. But generally, in the early stages of this cycle, through here, where growth is peaking, stocks will do better. And as we move into recession, bonds will generally do better. And the reason is that bonds are typically safer. And as people are apprehensive or afraid to invest in the more risky stock market, they will look to bonds for safety. And as the demand for bonds goes up, so does the price. And it gives, most of the time, an inverse relationship and extra protection in a market downturn. Now, a little bit deeper than just stocks and bonds, we look at the different types of investments that will do better or worse in the different stages of this cycle. So in the early stage, which is usually a recovery stage from recession, economically sensitive sectors will typically outperform, and the defensive sectors will typically underperform. So what that means is that generally technology companies, real estate, industrials, and what we call consumer discretionary, meaning things that people want, not that they generally need, tend to do better in this high growth period. Now, in the mid-cycle, generally it's a high growth period. And we don't see any particular sector significantly outperforming, but this is a good opportunity to rebalance the portfolio and make sure that our asset allocation, that we don't have too many eggs in one particular basket, that is in a good place so that we manage risk with sectors to enhance risk-adjusted returns. So as we move into what we call the late phase, where we start to slow down in our economic growth, typically defensive sectors and inflation-resistant sectors will do better or tend to outperform. Cyclical, meaning that they happen every once in a while, tend to underperform. So what that means is the types of businesses that typically do better in this late stage are what we call consumer staples, things that people need, companies that produce goods for the home, your toothpaste, your paper towels, healthcare companies, for example. People rely on healthcare. It's a need for them. It's not a want. It's a non-negotiable. And energy, for example, energy companies will be inflation resistant. So that's where we tend to move in the late cycle. And in recession, what we typically look for as far as the types of investments that will do better, and by better, I mean in recession, stable, because typically there aren't any particular sectors that do great in recession. We are typically looking for defensive, historically stable investments. We'll look at those consumer staples, the things that are non-negotiable to people. healthcare, which is also a non-negotiable for people, again, and utilities, for example, that's also a non-negotiable. People are not willing to shut off their water or shut off their lights if they don't have to. So by managing the portfolio to these standards and making the adjustments not only from a stock to bond ratio perspective, but also into the different types of sectors that do better or worse in the different stages of the economy, that's how we create an efficiently managed portfolio for better risk-adjusted returns. Thanks so much.